So a very good evening to all of you. So this is the lecture session for the chapter insurance claim that I have shared in your Google Classroom along with this assignment. So regarding the previous assignment and the previous PDF that I have shared with you, you have done two revenue account of a life insurance company. So I have shared with you the format, and also I have shared with you two numericals along with the solution. I hope all of you have done those two numericals. Okay, so now coming to the next part that of the same module, that is insurance claims. So in this lecture I shall be giving you a brief overview of the meaning of insurance claim, and in the next lecture I shall be discussing a numerical with you, and in the same way I shall be sharing a PDF and discussing the numerical. So in this lecture it will be better for you if you follow the PDF that I have shared along with this lecture. So coming to the point, what is insurance claim? So by the two words it is very much clear that what you are talking about is the claim that a person make with the insurance company upon any losses. So we are talking about general insurance here. Okay, so what is general insurance? The insurance that we do for our businesses, for our vehicles, for our goods. Okay, and in case of any losses, any untoward incidents, so what the insurance company does, they reimburses, okay, they indemnify our losses. So insurance claim, this particular chapter is going to deal with that problem of a businessman, of an insured, regarding how he is going to put the claim with the insurance company. Again I want to repeat that it is not with the legal procedure, it is related to the amount of claim the insured is going to make with the insurance company when the insured has actually made some losses. So say for example a particular person, he has taken an insurance for his business, he owns a shop and something happened, like maybe there was an incident of fire and his stock were destroyed. Now he will go and make a claim with the insurance company. Now when he will go and make a claim, on what basis he will make the claim, of what amount he will make the claim, what is the pattern in which he will come up to that particular amount which he is going to claim from the insurance company. It cannot be arbitrary. There is a fixed pattern in which he has to calculate, he has to show that this is the amount of goods, this is the amount of stock that has been destroyed because of that untoward incident much by the company. So again there are many other aspects. Okay, so we will go all these things go into all those things one by one. So first of all, if you look at the first page of the PDF, you will find there the meaning of insurance claim. Insurance claim means a request made by the insured to the insurance company for payment of the amount due under the terms of insurance policy, that is on the happening of the event for which the policy is taken. So that is the meaning of insurance claim. So if you go to the next, you will find claims under general insurance policies. Now in case of general insurance policies, what type of claims you can make? This is very important. You can claim for the loss of stock in trade. Your stock, your goods in your shop is destroyed by fire, is destroyed by flood, earthquake. So in those cases you can claim with the insurance company where you have taken up the insurance policy to indemnify your losses. Second is consequential loss. Now what is consequential loss? Understand, this is very important part of any general insurance policy. Now what is consequential loss? Suppose today a person owns a business, okay, he has a shop and say he has a bookstore. Now there was an incident of fire and much of the books were burned and he had to have suffer a lot of losses. Now this loss is twofold. This loss is twofold. The first is that his books are burnt, that is one loss. Second is, now say on day 1 his shop is burnt. Now immediately the next morning or day 2 or day 3 he cannot start up, or he cannot start his business like it had been the night before the fire happened. So because of that particular fire, his normal business operations will be affected for a long time. So that is called dislocation of the business. So say that will be for say 4 months, 5 months, 3 months, depending on the volume of the business, depending on the volume of the loss. Now, if the business is dislocated for say 3 months, so for these 3 months, the business is not going to function normally. And since the business will not have normal operations, it will lead to certain amount of losses of profit too. That loss of profit is nothing but consequential losses. So policy also covers the risk of such consequential losses. So that is the second thing, second type of claim which a particular insured can make with the insurance company. And the third is loss of fixed assets such as building, furniture, machinery, etc. Those kind of losses, claims for those kind of losses can also be made under a general insurance policy. So these are the three kind of claims that a particular insured can make with the general insurance company. Now coming to some of the terms, the first term is amount insured or sum insured. Okay, so what is it? This is the amount for which the policy has been taken. Okay, so and obviously the indemnification can never be the amount of sum assured. Say the sum assured is rupees 1 lakh, and for 1 lakh he is paying certain amount of premium. So even if his losses is more for an amount more than 1 lakh, he cannot be paid more than 1 lakh. That is the sum assured or the amount assured. Okay, the second is amount of indemnity. So amount of indemnity is the amount which the insurance company is liable to pay to the insured on account of loss of the insured property. So in this case there is another aspect which I will be discussing gradually. Okay, so indemnity is the amount which is reimbursed or which is paid by the insurance company to the insured to indemnify his losses. That means back to the previous position, the position which he held or which he enjoyed before the loss. So that is the meaning of indemnity. So the amount of indemnity means the amount which the insurance company is paying to the insured. The period of indemnity, it is a period during which normal activities of a business is likely to remain dislocated in consequence of the insured peril. So like I told you, if there is some problem, if there is some fire, okay, it leads to loss of damages. So because of the damages, what happens? The business is dislocated. So the period for which the business is dislocated is the period of indemnity. Okay, so generally the period does not exceed 1 year. Okay, and another concept is the amount of stock salvaged. Now what is stock salvaged? So whenever there is some loss, obviously if there is a fire, all the books will not be burnt. So some of the books will not be burnt or could be saved. Okay, that is the amount of there is the amount of stock salvaged. Okay, so which could be saved from being damaged. Okay, so these four terms will be used again and again in all the numericals related to insurance claims. So like sum insured, amount of indemnity, period of indemnity, stock salvaged. If you go through the PDF, you will get much more details regarding these four terms. And any confusion if you have, you can put up the question to me and I will clarify to you. Okay, now let's talk about the business little bit. Now what happens is that suppose there is a fire. So then immediately what happens is that the particular insured must take steps to reduce or to reduce the damage or to dose of the fire. So it should not be like that an insured here he will think that, oh, I have taken insurance policy, okay, let it burn. No, that should not be the case. Okay, that is the first thing, that the insured must take all necessary steps to reduce the damage. Okay, second thing, now the thing is that, so he has his damages and then he puts up a claim and the insurance company pays. No, it doesn't happen that way. So whatever is the loss, the insurance company will appoint a surveyor. The surveyor or the loss assessor will come, will investigate the circumstance and then will verify the books of accounts, the records, that how much stock was there in that particular business organization, how much stock was present at the time of fire, and after inspecting all those things, he will do the accounting part, and then he will calculate that what was the amount of stock held at the time of the fire and whether the person is like eligible to get the sum assured or not. So that is a process, and we in this particular chapter will be doing that part, the assessment that what is the value of loss that can be claimed with the insurance company. Okay, so there is a procedure for calculating the amount of loss of stock. So the stage 1 is determination of value of stock just before the fire, accident, flood. Step 2, determination of loss due to the amount of loss is equal to the value of stock just before fire. Obviously, whatever was the amount of value of stock just before fire, that is the entire thing is burned, and that is the amount of loss. And then you have to find out if there is some stock salvaged, if some of the stock could be saved, and then determine the amount of loss, value of stock on the date of fire minus stock salvaged. Now this value of stock on the date of fire has to be calculated using a trading account, a memorandum trading account. If you remember your trading account, there we have what? A closing stock, isn't it? So the closing stock is the stock present on the date of the fire. We have to calculate the amount of closing stock by preparing a memorandum trading account. We will do that gradually. Okay, as of now, just for information I am telling you all. So this is the amount of loss. Now comes the step 5 and the most important part, that is the application of average clause, if applicable. Okay, so now comes the most important part of insurance claim. Okay, listen very carefully to me. I'll speak very slowly in this particular part. Suppose today you have a vehicle, and the vehicle is valued rupees 10 lakh, and your friend has a vehicle and his vehicle is priced rupees 7 lakh. Okay, now both of you went to an insurance company and want to take up insurance policy for your vehicle. Now who will have a higher insurance premium? Obviously the vehicle whose value is more. The vehicle with a value of rupees 10 lakh will have a higher insurance premium. The vehicle with a value of rupees 7 lakh will have lesser insurance premium. So in the same way, any business, okay, any shop, when they're taking up an insurance policy, the value or the amount of the insurance premium is dependent on the value of stock held by the business. Is dependent on the value of stock held by the business. Now some certain businessman, they have a stock of say rupees 50 lakhs. What they do is that they say that my stock is rupees 30 lakhs and they pay less premium, because they know if they say that stock is 50 lakh, they have to pay much higher premium. Now this is what happened to a businessman. What he did is that to reduce the burden of insurance premium, he said that his stock is rupees 30 lakh, while actually his stock was 50 lakhs. And what happened? Unfortunately, a fire broke out in his shop and 50% of the stock was burnt. Now he had a stock of 50 lakh rupees and then 50% was burnt. That means stock valued 25 lakhs were burnt. But he has taken a policy for how much? 30 lakhs. He has taken a policy for 30 lakhs by paying less premium. By paying less premium. His policy of a stock of rupees 50 lakhs would have been rupees 5,000, but he paid rupees 3,000 and insured his stock for rupees 30,000 by telling the insurance company that he has a stock for 30,000 only. Now his loss is how much? 50% of the entire stock, and his loss is amounted to rupees 25 lakhs. Okay, his loss is amounted to rupees 25 lakhs. Okay, now understand, his loss was for 50% of the stock and it was 25 lakhs. The surveyor will come immediately and they will get to know that this particular person had more stock in his shop than he has mentioned or revealed with the insurance company. That means he has, in order to save or reduce the insurance premium, he has misled the insurance company. He has taken insurance premium for only say 60% of the stock. That means his stock was 50 lakhs, but he took a policy for 30 lakhs. That is, he took a policy for 60% of the actual value of the stock. And in that case, what happens? The average clause will be applicable. He will be penalized because he has paid less insurance premium. He will not be paid 25 lakhs. His loss was 25 lakhs, but he will be paid only 60% of 25 lakhs. He will not be paid the full amount. That is the application of average clause, if applicable. If the person would have paid rupees 5,000 the whole premium and shown that actual amount of stock that he held with him, then he would have got the entire amount of loss, 25 lakhs. But he did not. He has misled the insurance company. He paid less premium. He had shown less stock in his shop. He has shown 60% only. Because his stock was 50 lakhs, he has shown 30 lakhs. And thus, upon him, the average clause will be applicable and he will get only 50% or 60% of 25 lakhs. So, for that there is a formula also. So, amount of claim is equal to loss of stock into policy value by value of stock on the date of fire. Okay, so you can apply that formula, and that is how the average clause will be applicable in that case, and then that much money will be given by the insurance company to the insured. Okay, so try to go through each and every sentence of this particular PDF. It's a short one. In the next lecture, I shall be sharing with you the numericals of insurance claims. I hope most of the things are clear. Anything you have, you can ask me. So thank you. Take care.